The world is divided into active investors who believe that they can beat the market and passive investors who believe that's a fool's errand. At CBS MoneyWatch, we believe that passive investing is wise investing, and as it happens, so does our guest. He is Rick Ferri, founder of the investment advisory firm Portfolio Solutions and the author of the new book, The Power of Passive Investing. Welcome, Rick.
Thank you.
Now, a number of smart people, including Jeremy Grantham, say that markets always create bubbles. And so if all you do is follow the market, which is the essence of passive investing, you inevitably expose yourself to bubbles. Is that true?
I would imagine so. Sure, if you were a stock investor and you only invested in stocks in the 1990s and the PEs of the market went up to 35, that would be a bubble. But index investing is not just investing in one market and leaving it there for the rest of your life. It's not a buy and hold strategy. The essence of index investing is to have diversification among many different indexes, all of these indexes having different risks, and then rebalancing your risks every year at the end of the year. So if the market did bubble up, the US equity market did bubble up, you'll actually be selling at the bubble top and buying something that perhaps didn't do well, such as real estate or emerging market or small cap value stocks, which were the stocks that actually performed very well in the next 10 years. So if a bubble occurs in a particular market, it actually is not a bad thing for the buy, hold, and rebalance investor because you are selling at the top, if you will, or you're selling on the way up, and then you're buying on the way down. And that's really what you want to do in investing, correct?
But bubbles, at least in retrospect, always seem so obvious. Like right now, with treasury bonds at
gold.
3%. Yeah, gold sure seems like a bubble, or the bond market sure seems like a bubble.
Right.
There are other smart people talking particularly about the bond market right now, Morningstar, for example, say that you ought to have active investing there so you're not investing in what just looks like a train wreck waiting to happen.
You know, I heard these arguments a lot that you should go with active management because it appears that a bubble is forming. But the problem is when you look at the data and you look at how the active managers have performed in relation to the indexes, they still underperform, even in times of a bubble or a bubble bursting. So the premise that you should be in index funds goes beyond just is it a bubble or is it not a bubble? Because when you look at all periods of time, the indexes outperform, the index funds outperform the managers most of the time and most of the managers. So there's all kinds of excuses why you should do active management, and I don't really believe any of them.
The numbers just don't bear it out.
They don't bear it out. They don't.
ETFs have taken the index market by storm, and they allow people to invest in tiny slivers of various markets by focusing very sharply. But you have to wonder in emerging markets, say, or in narrow industrial sectors, how good is an index? After all, even a broad index is composed by human beings, and they involve those human beings' biases. Isn't an index also kind of a bet?
If you're doing a sector rotation strategy where you're using those slivers and you're going to rotate in and rotate out, sure, it's a bet. I mean, it's an active management bet from the top down, a beta bet, if you will, in a particular sliver of the market. That's active management. Just because you're using a portfolio that has 25 or 50 stocks in it doesn't mean you're not making an active bet. That doesn't work. The data in my book shows that typically you're going to underperform a buy, hold, and rebalance strategy by about 1% per year. If you do that, the Morningstar data shows this when you look at the dollar-weighted returns of various mutual funds versus time-weighted returns of mutual funds. People who are trying to time these markets, time these beta bets, are losing. And who are they losing to? They're losing to the people who are doing buy, hold, and rebalance because they're the ones who are selling as things get expensive and buying as things get cheap. So there's a transfer of wealth, if you will, from the tactical asset allocators to the buy, hold, and rebalance passive people.
What you buy in your buy, hold, and rebalance strategy is the broadest possible market index?
It depends on how you want to do it. There's many different ways of doing passive. There's a very simple approach where you buy a total global stock market and a total bond market, and that's it. And you do your rebalancing between those two. If you want to slice it and dice it more, then you do U.S. market, international market, or you could go one step further, U.S., developed markets, emerging markets, maybe real estate. Then you can do a FAMA French three-factor model where you get into small cap value type. So depending on how deep you want to go and what your level of sophistication is, that's how you're going to do it. But whatever you decide to do, whatever portfolio you come up with, the idea is to buy, hold, and rebalance and maintain that portfolio for the long term, because that's what's going to give you your return.
The data that is the heart of your book, that makes the case so persuasively for passive investing, is not a secret. It's
No.
been around for decades.
Decades.
Why do so many investment advisors still insist on recommending actively managed mutual funds or pursuing tactical allocation strategies with their clients?
Well, I can't speak for all advisors. I mean, our firm, all we do is buy, hold, and rebalance. But I think other advisors, some of them think that this is what their clients want, that their clients want them to try to beat the market. And I really think that's a disservice to the client, because the data clearly shows that that doesn't work. And I believe that advisors would be better off in the long run with their business model and for their clients if they didn't try to do that. So I've been pushing for years for people to think about their business model, advisors to think about their business model as longevity of a business model. And if you want to have longevity of a business model, you do very low cost buy, hold, and rebalance, because that's the best thing for the client. That's my opinion.
You do the right thing for the client. That sounds like a way to stay in business, doesn't it?
I think so.
All right. Rick, thanks very much.
Thank you. Appreciate your time.
And thanks for watching.